Hello everyone. Booking profit from an investment is as important as making the investment itself. But unfortunately, it can backfire drastically. So today we will study 5 good reasons for not booking your profits in haste. Well, we have all heard this story called the golden egg. During our childhood days, it's a simple story of a poor man in a small village who owned a hen that laid golden eggs. Every day, this hen laid one golden egg, much to the delight of the man. Soon enough, he became rich. One golden egg a day was sufficient for his needs. But here is the twist in the tale. This gentleman became greedy. He thought to himself, the hen must be having a lot of golden eggs in her stomach. Instead of getting one egg at a time, why not cut open her stomach and get all the eggs at once? He thought this was a brilliant idea, a masterstroke. He went ahead and cut open the hen. However, in his delusion, he found that there was no treasure trove of golden eggs hidden in the hen's stomach. He not only lost the hen but also his daily golden egg. So friends, the takeaway from this story is that the same principle applies to your investment decisions. The moral here is that one must not be in a hurry to get big returns. A small but steady stream of returns will eventually result in wealth accumulation and help you achieve your desired goals. Do not book your profits in haste. Let us now take a look at the 5 reasons for not booking profits in haste. Reason number 1: denting of long-term goals. Why do we invest in the first place? Because we have a long-term goal. A significant reason for making investments is to achieve one's long-term objectives, such as acquiring a house or steady income for the post-retirement period. Remember, it is good to remain invested in such investments for the requisite period. One must ignore events such as sudden increases in the market value and remain committed to steady, periodic returns. If you book profits after such events, then this will dent your long-term goals, ultimately ruining your financial strategy. Obviously, booking profits in haste is very risky in the long run. Reason number 2: loss of the compounding effect. Let us first understand what compounding effect means. Suppose you make an investment of rupees 100 at the rate of 10% per year for a period of 5 years, then as per your calculation, you will get rupees 10 per year, which means rupees 10 into 5 years equals to rupees 50 at the end of 5 years. Well, this is not how compounding works. Let us check the table to get a clearer picture. Please note, figures are rounded off to keep it simple. Year 1 equals to 100 plus 100 into 10%, which is equals to 110. Year 2 is equal to 110 plus 110 into 10%, which is equal to 121. Year 3 equals to 121 plus 121 into 10%, which is equals to 133. Year 4 is equals to 133 plus 133 into 10%, which is equals to 146. Year 5 is equals to 146 plus 146 into 10%, which is equals to 161. At the end of 5 years, the actual ROI is equals to rupees 61 and not rupees 50. This is the power of compounding. It can give you higher returns in later years. But if profit is booked in haste, then one will lose the compounding effect. Reason number 3: wrong decisions due to herd mentality. Herd mentality is a behavioral pattern where people tend to blindly copy actions of others by following their lead without thinking for themselves. Generally, this happens as a reaction to an adverse event or even a rumor of an adverse event like markets are going to crash. When profits are booked under such circumstances, it is a clear example of a decision made in haste without any introspection. Always avoid such situations and keep a broader perspective in mind, focusing towards your long-term goals. Reason number 4, risk of reinvestment. In a situation where profit is booked abruptly, that is before the decided period of the planned investment, you would have surplus cash. But now the challenge is the availability of more profitable avenues to invest your money. Sometimes it is possible that one may be forced to invest in other investments which may accrue lower returns than the original investments itself, ultimately making it a risky venture. Reason number 5, tendency to use such quick profits for unplanned expenses. The availability of a significant surplus amount can lead to instant gratification, that is, immediate and unplanned expenditures. This kind of expense usually results in the purchase of depreciating assets like a car, premium electronic goods, luxury items, etc., or even simply an unplanned vacation abroad. This is another challenge faced due to booking profit ahead of time. Well, now you know why you should not book profits in haste. One golden egg daily should suffice to fulfill your needs. If you cut open the hen, as mentioned in the story, you will have neither the hen nor the golden eggs. So act judiciously. We hope you have learned something new today, as it is our constant endeavor at Motilal Oswal to educate and make an investor a sound investor. Happy investing!
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.